Hey everyone! Have you ever wondered how a tiny, almost invisible fee could end up costing you a small fortune over your lifetime? Well, today we're going to pull back the curtain on index funds and show you exactly that. You've probably heard the term thrown around, but by the end of this, you'll know what they are, how they work, and why, for a lot of people, they're a total game changer. So, to really get why index funds are such a big deal, we have to start with something that sounds kind of boring but is actually super powerful. We're talking about fees and how a tiny little percentage point can have a massive, and I mean massive, impact on your future. So, here's the question we're going to tackle. Can a measly 1% fee really matter that much in the long run? I mean, it sounds like practically nothing, right? Just a penny on every dollar. But as you're about to see, when you let time and compounding do their thing, the math tells a very different story. Okay, let's picture this. We've got two investors. Let's call them Fund A and Fund B. They both start with $50,000, and let's say they both get a solid 7% return every single year for 30 years. Everything is exactly the same, except for one tiny detail: the fee their fund charges. All right, now let's fast forward 3 decades. Our investor in Fund A, the one with the higher fee, ends up with about $271,000. Hey, not bad, right? That's a pretty good outcome. But look at the investor in Fund B with the lower fee. Whoa, they're sitting on almost $360,000. That's a huge difference. Yeah, you're seeing that right. The difference is over $88,000. And here's the kicker. Fund B didn't win because it was run by geniuses or picked better stocks. It won for one simple reason: its fees were lower. That's it. That's the secret sauce we need to understand. So you're probably asking, okay, how do I get those lower costs? Well, it comes from a really simple, almost elegant idea. Instead of trying to be a hero and beat the market, you just match it. And that is the core idea behind an index fund. So what is an index fund exactly? Well, it's a type of investment. It could be a mutual fund or an ETF, which are really just different wrappers, that doesn't try to outsmart anyone. Its only job is to copy or mirror a major market index. Its goal is to give you the average return of whatever group of companies it's tracking. It is the ultimate go-with-the-flow investment. And the cool thing is, there's an index for pretty much everything. Of course, you know the big one, the S&P 500, which is just the 500 biggest companies in the US. But you can find index funds that track tech stocks or much smaller companies. We call those small cap, or international stocks, or even bonds. It's a way to buy a whole slice of the economy all at once. Okay, so why in the world are index funds so much cheaper? It all boils down to two very different approaches to investing, what we call active versus passive. And this right here is the key to the whole thing. Think of it like this. Active investing is like hiring a fund manager who's constantly trying to pick winning stocks and dodge losing ones. All that research, that constant buying and selling, well, it's a lot of work and it costs more. Now, passive investing, that's our index funds, is more like putting the investment on autopilot. It just follows the market index. There's not a lot of trading going on, and because it's so much simpler, the costs are way, way lower. Now, those low costs are a massive, massive plus. But, no investment is perfect. And to be a smart investor, you've got to know the good and the bad. So let's take a balanced look at both sides of the index fund coin. So the number one benefit, the big headline, is without a doubt the lower cost. Because these funds are just passively tracking a market, they don't need to pay for huge teams of fancy analysts. They also don't trade stocks very often. That's what's called low portfolio turnover. And all those savings, they get passed directly on to you. But here's the trade-off. An index fund is tied to its market, for better and for worse. If the S&P 500 takes a nosedive and drops 20%, guess what? Your S&P 500 index fund is going down 20% too. There's no manager there to try and soften the blow. You get to enjoy all the highs, but you also have to ride out all the lows. So, knowing those risks, why are index funds still so incredibly popular? Well, it all comes back to playing the long game and recognizing a simple truth about how markets work. You know the old saying, if you can't beat 'em, join 'em? Well, that's pretty much the philosophy here. Decades of data have shown that most professional money managers, the very people paid a lot of money to beat the market, actually fail to do so over long periods, especially after you factor in their higher fees. So a lot of investors just said, you know what, it's better to just get the market's return than to pay someone to try and probably fail to beat it.
And that's really the superpower of index funds. That little tiny cost advantage we talked about, year after year, it compounds on itself. It's that snowball rolling downhill, just getting bigger and bigger and bigger. Over decades, it can add up to a truly significant amount of money. Just like that $88,000 we saw at the very beginning.
So I'll just leave you with this. We've seen how just one single percentage point can completely change the story of your money over time. The only question now is, what could harnessing that power of low costs and compounding mean for your future?